Sufficiency and appropriateness. Sufficiency and appropriateness in audit evidence, right? We want to make sure that evidence is sufficient and appropriate. Sufficiency is the measure of the quantity. So if you have enough audit evidence, and then appropriateness is the measure of the quality. So you want to make sure that you have evidence to support enough to reach an opinion, as well as you want to make sure that the evidence you obtain is quality evidence. It's not evidence that was given to you solely by the client. It's not evidence that could have been edited or forged. And it's something that actually verifies it, right? There's a lot of times where you get evidence and then you think about it and you're like, that doesn't really actually corroborate what I'm looking at here. So appropriateness, the measure of quality of audit evidence, that is its relevance and reliability in providing support for or detecting misstatements in the classes of transactions, account balances, and disclosures, and related assertions. If you think about it, if you go in Bloomberg and you find the price of the stock that a client is holding, maybe they're a hedge fund, right? They hold stock in other companies, and you get the beginning balance, or you get the value of that stock at the beginning of the year, that might not really do anything for you. Yes, it's evidence, but what is that evidence really corroborating? Think about that, make sure that it actually is useful. The auditor should consider the sufficiency and appropriateness of audit evidence to be obtained when assessing risks and designing further audit procedures. Super important, something to assess in planning and constantly think about throughout the entire audit process. The quantity of audit evidence needed, and going back to sufficiency here, is affected by the risk of misstatement. The greater the risk, the more evidence is needed, and this ties into sampling and it ties into testing. The greater the risk, the more sampling you need. The greater the risk, the more testing you need. The greater the risk, the more evidence you need. And also, by the quality of such audit evidence, the higher the quality, the less evidence may be required. Notice we said may there, because you still need a decent amount of evidence, just depends on the situation. Accordingly, the sufficiency and appropriateness of audit evidence are interrelated. However, merely obtaining more evidence may not compensate if it is of a lower quality. Sometimes less is more. If it's solid evidence, getting more may not actually be helpful. Accounting assertions. Let's dive into these. As I mentioned earlier, we will be seeing these in other lessons as well. And these are existence, valuation, completeness, cutoff, rights and obligations, all of these assertions that are made by management. A given set of audit procedures may provide evidence that is relevant to certain assertions, but not others. For example, inspection of records and documents related to the collection of receivables after the period end may provide evidence for existence and valuation, although not necessarily the appropriateness of cutoff. I'll just revisit that for a second. What we're saying here, inspecting records and documents that will support the collection of receivables and support that this was properly recorded, doing this can give you evidence for existence, making sure that you actually collected the receivables, and valuation, making sure that the receivables are actually at the values that they're reported at the values that they actually are. However, this may not actually give you any evidence for cutoff, the cutoff assertion, meaning it may not actually validate that the receivables are recorded in the correct period. Just keep that in mind as we continue on. On the other hand, the auditor often obtains audit evidence from different sources or of a different nature that is relevant to the same assertion. So again, we could be sending out accounts receivable confirmations to the client. That is going to actually knock off two of our assertions here. It's going to help you verify their existence and the valuation, making sure that we understand how much a customer actually owes the client. But again, it may not provide evidence for cutoff. We see here a procedure which gets you a certain piece of audit evidence can only be valid for one assertion, maybe multiple assertions, and then sometimes not other assertions as well, making sure we understand that. Another example here, for example, the auditor may analyze the aging of accounts receivable. That's a process by which we see, if a balance that is owed to the client is outstanding for 90 days, you may not be getting that balance, because usually if the client collects everything within 30 days, the longer this balance is outstanding, the less likely they are to collect it. And as such, you should probably write that off. And subsequent collection of receivables to obtain audit evidence relating to the valuation of the allowance for doubtful accounts. You've got our accounts receivable aging schedule, right? We kind of build it out saying, here are the amounts owed to us in the next 30 days, the amounts owed to us in the next 60 days, 90 days, and then 120. It's generally what I've seen in my experience there. And then we have certain percentages, right? So we say, okay, any amounts owed to us in the next 30 days, we have, let's say, this is an internally generated percentage by the client, something also that the auditor could corroborate as well, part of their audit. Let's say we get 90% of the money owed to us within 30 days. By the time it's outstanding for 60 days, there's a lot less chance that we'll actually collect it. Maybe there's a 75% chance that money owed to us that's outstanding and owed to us in 60 days now, we'll collect it. And then 90 days, maybe that suddenly drops to 20%. Very much not likely we'll get any money owed to us if it's outstanding that long. And then 120 days or more, maybe there's a 2% chance that we're actually going to collect anything owed to us if it's been that long. Now, that's the process. You could analyze this aging report and the subsequent collection of those receivables to make sure that this allowance for doubtful accounts account, I'm going to keep saying account. This allowance for doubtful accounts balance is correct, because this is, relatively speaking, an estimate based on estimating how much you expect to not collect from customers because, well, they just decided not to pay you. Furthermore, obtaining audit evidence relating to a particular assertion, so for example, the physical existence of inventory, is not a substitute for obtaining audit evidence regarding another assertion, for example, rights and obligations. We see here you could observe an inventory count, which would give you understanding over the existence of inventory. However, that doesn't necessarily mean that the client owns the inventory, right? It could be stolen. I mean, that's just one example. It could also be pledged as collateral to some loan officer. So that would be something that you could not corroborate by just a physical inventory count. You would need to examine, to make sure, I'd say for rights and obligations, we'll go over this a lot more in our cycles lesson, but to make sure that the client actually does not have these pieces of inventory pledged as collateral, you could review minutes from the board of directors. You could send out confirmations to any lenders that they have done business with. You could look through any debt agreements. So I would say that would be something to take in a different process than a physical inventory count. Again, we've got different assertions, different procedures to verify each one. Hey there! Are you ready to not only pass your CPA exams, but truly understand and enjoy the material while studying? I know it seems impossible, right? Especially to enjoy the material? We'll do it together. Tap into the power of CPA.examprep.ai, where we've got personalized quizzes, multiple choice questions, memorization guides, flashcards, simulations, all tailored to your learning. Our adaptive study planning puts you on the fastest path to success and lifts you back up if you fall behind. Avoid wasting your precious time and money attempting an exam with a low chance of passing, because who wants that? We want to get you through this process as quick as possible. Our exam readiness prediction lets you walk in with confidence, knowing that you're prepared for success on exam day. Thankfully, there's no payment method needed to get started, so why don't you come join us? Visit cpa.examprep.ai and let's achieve your exam success together.